Well, ladies and gentlemen, our speaker tonight, I couldn't be more happy that Dr. Schiller has agreed to be the first Beatty Family Business and Law lecture speaker. He is someone who, speaking very personally, I've been a great admirer of his work for a number of years. He is the Arthur M. Okun Professor of Economics in the Department of Economics and the Cowles Foundation for Research in Economics at Yale University. He has a BA from the University of Michigan, completed his PhD in economics at MIT. His work has been particularly influential in the areas of financial markets, financial innovation, behavioral economics, an area in which he's really a pioneer, macroeconomics, real estate, statistical methods, and public attitudes, opinions, and moral judgments regarding markets. His research a number of years ago on the disconnect between stock prices and dividend patterns heralded what became fairly obvious a fall in market prices. His book, Irrational Exuberance, which predicted an imminent fall in equity prices, was published in March 2000, the very month that the major U.S. stock indices hit their peak. In a revised edition of the book in 2005, he warned that the United States seemed to be in the midst of a real estate bubble, that bubble might burst, and if it did, it would be followed by a financial crisis. Law students in particular may be interested to know that his 2003 book, The New Financial Order, evoked the theory of justice of legal philosopher John Rawls and suggested that new financial instruments and new financial technologies can be applied to overcome some of the world's greatest economic inequalities. Last fall, he published a book on the subprime mortgage debacle. Earlier this month, his latest book, co-authored with Nobel economics laureate George Akerlof, was released, and it is that book from which the title for tonight's lecture has been drawn. Dr. Schiller developed, with Carl Case, a repeat sales home price index, really indices that are widely used. They are absolutely ubiquitous. If you read any report in the financial media about U.S. home prices, you will see reference to the Case-Shiller index. Just a few weeks ago, Dr. Schiller was named the 2009 winner of the Deutsche Bank Prize in Financial Economics. I want to say one last word about the timing of this lecture. I first invited Dr. Schiller to give this lecture a little over a year ago. It was March 14th, 2008. The significance of that date is that later that day, Bear Stearns announced that they had just received an emergency loan from J.P. Morgan, backed by the Federal Reserve, and at that moment, we moved into a much more significant and more dangerous stage of what, up to that point, had usually been referred to simply as the credit crunch. As we worked more to try to firm up a time and a date for his lecture, in July, IndyMac collapsed. We continued these discussions in September. Well, first August, Fannie Mae and Freddie Mac went into conservatorship. In September, Lehman Brothers, of course, collapsed, but by about that time, we had had a date firmed up. I'd like to think there's no connection between our discussions and the current financial crisis, but all I can say is maybe you want to check the papers tomorrow morning. But in seriousness, Dr. Schiller is one of the most significant economists, one of the most important writers today on issues like bubbles and financial crises. We're delighted to have him here. And so I would now like to call on Dr. Schiller to deliver the first Beatty Family Lecture in Business and Law, Animal Spirits, How Human Psychology Caused the Current Economic Crisis. Ladies and gentlemen, Dr. Robert Schiller.
Well, thank you for that very nice introduction. I'm very honored to be your first Beatty Family Lecturer. I've been trying to remember when I've been here before in London. Somehow it feels like home. But I'm trying to think. I grew up in Detroit, and that's not that far from here. And when Susanna asked me if I would like a can of pop, I And that brought back my childhood. In Connecticut, where I now live, they don't say that. So somehow it seemed very... I'm trying to remember. It seems that when I was a child, my parents drove me and my whole family to Toronto for, what was it called? Expo 67 or something? That sounds right. It was Montreal. So would I have driven through London?
Yes.
I would have. Okay. So it's nice to be back. So I'll talk for about 40 minutes, and then I hope that there'll be questions. So I've written a book with George Akerlof. He's a professor at UC Berkeley. You don't have to be in the same department to write a book. Just on the telephone all the time. And we've been working on this book for about 6 years, but decided to come out with it now because we think it's relevant to the world economic crisis that we're now in. The title of our book comes from a statement that John Maynard Keynes made in his 1936 book. Most of you haven't read this book probably, right? Called The General Theory of Employment, Interest, and Money. But I think it's the most important economics book of the 20th century because it launched what we call Keynesian economics. And in this passage, I think he gives one of the core ideas of his book. And it uses this term. Does this thing work? Oops, it doesn't. I can't go back. I have to go back with the arrow. I'm trying to... this will be our... Good. So what Keynes was talking about in this quote here is that we just really don't know the future. And you have a lot of people pretending to know the future, and they make careers of pretending to do that. But you know, they're show people, right? They're not... Nobody knows. And every business decision depends on some estimate of the future. And what Keynes is essentially saying here that if people were really rational, maybe they would just be paralyzed by uncertainty and do nothing. But there's some human impulse to act. You don't want to just sit around and do nothing all your life. And you never come across a really solid business opportunity, so you say, I'm just going to run with something. That's animal spirits. Unfortunately, animal spirits are not uniform. They get slammed at certain times. And that, we think, is the essential lesson to understand the current economic situation. Some of us are affected by very concrete things, namely, you lost your job, they're foreclosing on your mortgage. This isn't psychology, this is real. But underlying it, there are people who are not so affected. They're anticipating something that they imagine will happen, and so it affects their actions. And it's in these animal spirits that we see the real cause of this crisis. So what's happening now, all over the world, and it is really a shocking development, is businesses are deciding to postpone hiring people or building new factories or expanding operations because they think these are bad times, this isn't the time to do it. So they lay people off, and that leads to another round of problems that the people are laid off and that they're unable to spend. They tell everyone about their experience, and other people start pulling back and not spending. And so the animal spirits are dampened. Maybe you have the same impulse. A lot of people, most people want to do something, but you just have the sense that I can't do it now. And so somehow we get into a period of lost opportunity. I met someone from Moscow the other day. I'm just mentioning because it was from so far different part of the world. He said he was in the metro last week. It's so quiet here. There's nobody right. That's their subway, their underground. And he said he's discovered that the traffic jams are gone in Moscow. It's like everyone's staying home. But I'm just mentioning Moscow, but it's happening in so many places around the world. So it's not as if we've lost our general desire to do things, but we're temporarily out of it. So my co-author, George Akerlof, had the idea that we should get as a cover illustrator a special order from the cartoonist that he admires, Edward Corrin. I don't know if you've noticed him. He does covers for the New Yorker magazine. And all of his figures look like animals. And so we asked Corrin to do a cover for our book, and this is what he came up with. So this is, I'm very pleased that he agreed to do it. He's now 76 years old, I think. But he still has his genius. So this shows animal spirits. So that's some economic chart. And you can see the varying animal spirits. And they're all animals. So that's what this book is about. I like to talk to taxi drivers because I learn a lot from them. They're very open and direct. I had a taxi driver in New Jersey the other day. He said to me, "What is going on?" He said everything was going fine, and then all of a sudden the economy is bad, and he has a little business, is in big trouble, and he said, "I just can't make any sense of it." So that's what we're trying to make sense of. There's been a revolution in economics in the last 10 or 20 years, which we call the behavioral economics revolution. And I think it's getting back to a broader social science perspective in economics. The economic profession, and I was with them on this, through much of this, so I'm self-criticizing as much as anything. But the economics profession had modeled itself after theoretical physics, and they wanted to do mathematical models, which is okay as part of what we do, but I think it got carried too far. And we lost the insights from other social sciences, psychology, sociology, particularly, but even political science and others. And animal spirits, we think, is the big driver of the economy. Maybe the responsible for most of the fluctuations that we see. But that's contrary to the thinking of economists. They always want to talk about something concrete that we can look at. So maybe the central bank did it, which always struck me. They like to blame the central bank for all of our problems. But it doesn't seem to me that's usually right, because their job as a central bank is to stabilize the economy. So it seems kind of unlikely that they would do such a bad job of it that they would be the source, the primary source of instability. There's a whole school of thought in economics called real business cycle theory, which asserts that all of the drivers of the economy are technological change. It's a nice hypothesis. I don't think it's right. There is some truth to that. When they invented railroads, that created investment opportunities that drove the economy. And when the railroads were completed, they didn't have that. There's some truth to that, but it doesn't seem to be explaining things like now, for example. There's no change like that underlies what's happening. So we have a theory of animal spirits in our book that emphasizes a number of things that are usually not mentioned by economists. Certainly not central to what's happening, but we think they're central to what's happening now. There's 5 of them here. Well, first of all is confidence. Non-economists talk about it all the time, and I've just been talking about it. But generally, the economics profession considers it as something unmeasurable or inconsequential. But it's this fundamental thing. Do you think that it's good time? Do you think this is the time to invest or the time to hire? But it goes beyond that. I think also animal spirits should be a broader concept. And the other things that George Akerlof and I feel should really be emphasized, that there's other aspects of human thinking that change through time that explain economic events. One is our changing sense of fairness. And we can get very angry and upset when we think that we're not being fairly treated. We're seeing that recently. Since we hadn't seen so much of it when we wrote the book, but it's coming out now. The anger that's developed in the United States over the... I don't know, do you follow this story? AIG was given, the executives were given huge bonuses. I was just visiting the Los Angeles Times, and the writer there told me that he said he was just astonished at the email they're getting of anger. There was a lot of emails saying we have to kill those guys. Obscenities. He said, I've never seen anything like that. It's a little scary to me. But I think people, if they're not fairly treated, it affects how the economy runs. They have to feel we live in a fair and just society. The other thing that happens over a business cycle is corruption. Corrupt activities increase on the upside. And I make even a less strong term than corruption is bad faith. It goes back to ancient Rome. Good faith is bona fides. I guess you know that in a law school or something, Latin. Also, money illusion, that people are confused by the money supply, or changes in the money supply and the change in prices. I'll get back to some of these theories in a minute. And finally, we emphasized something that is I think it's kind of new with this book as a part of economics, but it's part of the psychological literature. Notably, psychologists Roger Schenck and Robert Abelson have written a number of papers. Roger Schenck is also an artificial intelligence expert. But they're trying to think about how the human mind works. And one thing that they have stressed is that it tends to be built around stories. That is, we tend to hang our memories on stories. And I talk about particularly human interest stories. And so our actions are affected more by the story than by the facts in many ways. I guess newspaper writers or journalism schools tell you this, right? They're trying to write a news story, put some human interest in it, otherwise they won't read it. But it goes way beyond that. And that we think that actually economies are driven by stories. Stories that have a word-of-mouth potential. And I'll come back to this in a minute, but it's a very different, it's called narrative-based thinking. Schenck and Abelson said, if you try to think back what you were doing 10 or 20 years ago, you probably don't remember anything. You just remember the story. This kind of, our mind tends to develop a narrative about what we were doing. But it's also about what the economy is doing. It links back into confidence, because the story of the economy is what generates our sense of confidence. Anyway, what I want to do now is I'm going to tell you about 3 countries. I'll apologize for starting with the United States, but that's the one that I know best. Then I'm going to move to Japan, and then, which is an interesting story about the economy. And then I'm going to come to Canada with relatively less knowledge, but and then I'll wrap up. So let's start with, I want to be concrete about animal spirits and change it. So I want to start with looking at, the stock market in the United States. This is a data set, which is on my website, but I've assembled this data set. And, well, the price series is the Standard & Poor stock price index, composite stock price index. And it just shows what the stock market has done since 1871. The green line is earnings on the companies that underlie this. The thing I wanted to emphasize is that the recent experience is most unusual. This boom leading up to 2000 is almost unique in U.S. history. There's only one other example, and it's right here. It's smaller, but percentage-wise, it's about the same. This is the Roaring 20s, and it peaks in 1929, and it drops to by 80% by 1932. Okay, I mean, everything is corrected for inflation. So you can see that there's only been 2 bubbles. I call these bubbles. This is a bubble. Okay, see how it's growing exponentially? It peaks, and then it bursts sharply. What happened, people ask? This is like the taxi driver. What happened in They've never been able to isolate, and people have tried, any fact or thing that caused it, except that maybe it appears we were on an unsustainable period of euphoria or excitement, animal spirits that had to come to an end. It couldn't go on forever. And when it came to an end, people started looking around. There was a negative contagion. We think there's kind of a feedback of excitement, increased excitement, optimism. There was a story in the 1920s. What was the story? It's about the automobile, the radio. We started getting the first radio broadcasts. The telephone, everyone had a phone. Can you believe it? By the mid-20s, the average person in the United States was making 200 phone calls a year. Okay? Now, you might be able to beat that now, but that was something. That was a revolution. So they had the idea that technology was... Everyone got their first washing machine. You got a car, washing machine, radio. Everything is so different and moving so fast. They came to an abrupt end. Similar here, we had... this might be called the internet bubble, or we had a similar sense that technology was moving very rapidly. The other thing that was happening here in this period was that there was a sense of capitalism triumphant. We all learned not to trust government intervention. We've learned our success in business. There was a huge cultural change, I think, not just in the U.S., but all over the world. That we were just talking about the book, The Ugly Canadian, and not many Canadians have read it. It was written by a Canadian, whose name is, what is...
Rachel Marsden.
Rachel Marsden. Anyone here read her book? I read it. I had a Canadian student. But anyway, Rachel Marsden said that Canadians got to be they lost their sense of equality, somewhat. They got into this business mode of thinking that just like everyone else in the world. And so, I'm not blaming Canadians. I'm saying it was a worldwide event for thinking that my role in the world is to be a business success. And I'm going to do it because look the amazing things that are happening. And that broke suddenly in 2000. This is just the price-earnings ratio. And you can see there's two periods of enormous price-earnings ratio, 1929 and 2000. There's no theory that finance people have to explain this. There's no... this thing I've been debating for many years. And I think this is a measure of animal spirits. This is the volatility of the stock market in the United States. That is, it's a 30-day moving standard deviation of daily percentage stock price changes. And you can see what happened. This is actually September of last year. This is at the time of the Lehman bankruptcy. It's also the time when the U.S. Congress voted down the TARP plan and then voted it back in. Somehow it got people really spooked. And the market was just going wildly up and down. There was this one other period of volatility in the 1987 stock market crash, but it was very isolated. Except for that experience, you have to go all the way back to 1929 to get a period of volatility. I believe that the Depression parallel is very important. Not that we're going to have another Depression, but a lot of things are happening now that are similar to what happened then. And that's worrisome. This is a home price series that I constructed, the red line, for the United States. When I was writing the second edition of my book, Irrational Exuberance, I wanted to give the same long-term perspective on home prices that I had on the stock market. But I asked people, well, where can I get a 100-year-long home price series? To my surprise, people said, there isn't one. And by the way, there isn't one for any country in the entire world. And I thought, how can that be? Housing is a big asset. It's comparable or bigger than the stock market. And nobody knows what prices did. So I actually found snippets of indexes that people had constructed at various times, but for some reason they hadn't been spliced together. So I put together for the first time a 100-year-long home price series. And again, it's corrected for inflation. And the amazing thing is, look what's happened recently. This is the biggest bubble in U.S. history. The market went up, and it's come down, most of the way back down. And if you see it in this long perspective, you can see how unique it is. The only other thing here is this thing, this boom. It has a name. Do you know what the name of this boom is? You probably heard this, but you're not. What? They happened in Canada too, I think. Same thing. The baby boom, yes. Because the soldiers came home from the war and they wanted to have a family and have babies. They wanted a house, and there was a shortage of houses. But I think it was different. The story was different. This was post-World War II. The story was totally different. They were not speculative bubble at this time. What's happening here is people were worried that home prices are rising at a rapid rate, and that if I don't buy a house, I won't be able to afford it. Here, they weren't worried about that. They were, in fact, told that maybe you just want to wait because they're building lots of houses and you can get one later at a better price. But this boom here that we're focusing on is driven by a story. It's a story of capitalism triumphant, of we're running out of everything, including oil and copper and land and everything else because of the rapid growth. And it spooked everyone. It's like a gold rush or a buyer's panic. The gold rush in the 19th century, there were several of them, but they were kind of irrational behavior. People were overreacting to some news. And it happens again now. It's not driven by fundamental, not by building costs, by population, or interest rates. So I think it's driven by psychology. And it's this up and down is what ultimately explains what we're going through. I'll just show you some U.S. cities. This is New York. You can see that it's split up by low, middle, and high-priced homes. And these are our S&P Case-Shiller indices. You can see that in New York, the home prices went up the most for the small homes. And this is because there was a subprime lending revolution in the United States, also happening in Canada, but at a much lower rate, where they were making loans to people who were low income and generally not considered creditworthy so that they could buy houses. The effect of that is that they bid the prices up of houses. Of course, it's a very unfortunate story because these people are generally being thrown out of their houses now, or they're being foreclosed on. And here's a similar thing for Miami, Florida. I just want you to reflect on these pictures because look what happened in Miami. Home prices, all three tiers, were just about constant. You can take this back. You go all the way back to the 1970s. There was another boom, not as big in Miami, but just flat prices, unchanging. And then all of a sudden, after 2000, they go up and they come back down. But my favorite picture is Las Vegas. Again, nothing happening in Las Vegas until just around 2003, 2004, and they went up and they came back down. I just visited Las Vegas for the first time in my life. I'm not a Las Vegas type person. I was invited to give a talk there. And what a phony city, or something that's bad about that city. But nonetheless, they were pretty stable. Something just got into their blood all of a sudden. And you can't explain this by interest rates or the Fed. It was some sort of psychological, social contagion. This just shows real GDP in the U.S. We had big swings in the Depression. The GDP went down, and this is World War II. It's been very stable since then. The U.S., UK, Canada are all very stable countries. So far, they have been. But I think maybe it has encouraged some kind of complacency. And I'm a little worried about the future. So far, there hasn't been much. It just revised up. This doesn't show it. Revised down the GDP growth for the fourth quarter. The fourth quarter in the U.S. GDP fell at an annual rate of 6.2%. It's not shown here. But still, I'm worried that we're going to get more of the kind of volatility that we saw before. I wanted to move to Japan now. The Japan story is a little different. This is the real Nikkei stock price index from January of '84 until January of 2009. Look how different Japan is. Look at this incredible boom in the market. And then it peaked on the last day of 1989. Funny, it was the very last day of the decade. And it just collapsed. And look what it's done since. It's been 20 years. And the market is still down 2/3. So much for stocks for the long run. Unless 20 years is a short run. So what happened here? I think that this period was a period of Japanese euphoria because apparent Japanese successes, they were competing so well with the rest of the world that they started bidding up the prices of everything. And it had to come to an end. Again, people say the Bank of Japan did it by tightening credit. You know, that doesn't sound right to me. It sounds to me something more fundamental was going on. I did a questionnaire survey with my two colleagues, Yoshiro Tsutsui and Fumiko Konya, where we asked questions of both Japanese and U.S. institutional investors about both the U.S. stock market and the Japanese stock market. And we found that the Japanese were euphoric. They were more optimistic about both markets. But what was particularly striking was when we asked the Japanese respondents, what do you think the Nikkei is going to do in the next year? Up 9.49%. We asked the U.S. respondents, down 7.67%. That's the average answer. But these are all professionals. How could professionals come up with such wildly different forecasts for Japan? Well, I think you had to be there to know. But if you were sitting in Japan, you got caught up in some kind of enthusiasm. And the rest of the world was skeptical. So this is the Japanese real estate bubble. It peaked in roughly the same time as the stock market bubble. We saw huge increases in Japanese land prices, and then it collapsed for 15 years after that. It was around here that the rest of the world was, do you remember this? In the 1980s, people were saying, did you know that the land under the Emperor's Palace in Tokyo, if priced at the highest price seen for Japanese urban land, would be worth more than the entire state of California? Do you remember that? Some of you remember that. It was a joke. Like everyone around the world was laughing at Japan. But it didn't affect them until suddenly the thing burst. And then we had 15 consecutive years of drop. It started picking up again, but I suspect it's going to go down from here because the Japanese economy is in such terrible shape now. This is Japanese GDP. And I have various events marked here. But I think the most important event is the end of the twin bubbles in the stock market and the housing market. And it represents a change in Japan. The biggest drop, the fourth quarter of 2004, GDP was down 13% on an annualized basis. So Japan is in real trouble all of a sudden. I think there's a difference. This bubble, this period was a Japanese phenomenon. This time it's a world phenomenon. The story was different. What was the story driving Japan? It was the story, I hate to say it, of Japanese superiority. This was the story. Long-term thinkers, they work together really well. The management is dedicated and loyal to the firm, and they can outweigh anybody else. They can lose money for 20 years, but eventually they'll prevail. They were writing books about that all over the world. And everyone believed it, but the Japanese believed it the most. But this is different. This story now is a world story. And it's something about the world is in trouble. And so Japan is being pulled along with this crisis. So I said I would talk about Canada. I'll try to pull together data here. The first thing about Canada is that in terms of the stock market, it is awfully similar to the United States. And so I have shown here from January of 18 to March of 2009, I have, in real terms, I got the consumer price index for both countries and the stock, the TSX and the S&P. And basically, Canada and the U.S. have been very similar, although it seems like the bubble was a little bit stronger in the U.S. in 2000, whereas it was more recent in Canada. This is Canadian stock market. I only have it back to 2000, but the same event occurred at around the time of the Lehman bankruptcy. There was a huge spike in Canadian stock market volatility. But what about the real estate market? Well, I've been always wondering what happens in Canada with real estate. The people here say that it's more stable and it's not so bubbly as in the United States. And I think maybe that's right. But this picture, the red data came to me from Professor Sir Somerville at UBC, and it's a Vancouver repeat sale home price index. So you can see that there has been volatility in Canada. We think Vancouver is the most volatile city. I don't know why. Maybe you can tell me why Vancouver. I think it's because it's a glamour city. It's on the West Coast, so it's a little bit, there's a geographical contiguity. They're a little bit like San Francisco or Los Angeles out there. A lot of Asians are moving in and speculating, maybe. That's what at least that's the story they tell in Vancouver. There's this huge spike. This is the most dramatic real estate spike that I've ever seen. It occurred in Canada. I asked Somerville, "Are you sure?" And he said, "I'm sure. This is right." There was a huge crash in real estate there. But his data ended in 2003. But I managed to find, actually it's been in the newspaper, I don't know if you read it. Canada has just developed, a company called Terranet has developed repeat sales price indexes for Canada. Some stories say, like the Case-Shiller indices. So I don't know anything about them except that they are using a method similar to mine. So I'm inclined to want to look at them. But I have them superimposed on the U.S. So the USA is red and Canada is blue. And their data only go back to 1999. That was the period of the enormous boom in the U.S. It looks less dramatic here because I've stretched it out. Right? And the previous chart, this is the same red line that I had in the previous chart, but it went all the way back to 1890, which would be out there in the hallway on this scale. So it doesn't look as dramatic. But this is a dramatic boom in the U.S. So their data is saying something not as big, but that there is this is a six-city. I'm not sure it applies to London, because here it would be the six biggest cities of Canada. But anyway, it seems like there has been a boom in Canada, doesn't it? And prices are falling now, but not as dramatically as in the U.S. But if you extrapolate this, I don't know where we're going. The thing that strikes me as odd is the stock markets are so similar and the housing markets are much less similar between U.S. and Canada. But I guess that's because financial people can go back and forth between two countries and easily, whereas it's hard for someone in Canada to buy a house in the U.S. Or I guess you do it in Miami, though, right? In fact, I was just thinking that that Miami bubble was part Canadian. Right here. We created a futures market, my colleagues and I, at the Chicago Mercantile Exchange on single-family homes. And that will make it easier for Canadians to speculate in the U.S. I hope that's not what happens. I understand they're working on or developing a futures market for Canadian housing based on these indexes in Montreal. Anyway, so I just wanted to talk about what we do about this. And this is apropos because we're leading into the G20 meetings in London on April 2. And President Obama and Stephen Harper and other G20 country leaders will be there to discuss this crisis. And I think this is a very significant meeting. Some forecasters are predicting a lot of protests at this meeting. This may be the most protested meeting in recent history. That's because the level of anger has risen so high. And I don't know why they should protest people trying to solve the problem, but we'll see what happens. But I think that this G20 meetings are very important because it's something that has to be coordinated around the world. This is a world problem. And if any one country tries to deal with the crisis on its own, it can't do it because the effects will be diminished by the international transmission. Also, there's worry that there will be protectionist measures that will develop. Each country starts to view the other countries as a problem. You know, our auto industry is suffering, so let's put protective barriers around our own industry, which seems to solve the problem, except you forget that they will retaliate. And this retaliatory sequence is not healthy for the economy. It's not healthy for international relations either. And we have to consider other consequences. So I think it's very important. I wanted to just talk about what has to be done. And the first thing Dr. Loff and I talk about in our book is that we need deficit spending, fiscal stimulus to get the economy going. and probably in every country and on a bigger scale than happened so far. So in the U.S. earlier this year, Congress passed a $787 billion stimulus package, which will be tax cuts and expenditure increases to try to create jobs for the U.S. economy. But even if you look at the predicted consequences of this coming from the very people who are doing it, the unemployment rate will still top 8% in 2010. If you look at the Council of Economic Advisors, they say we'll shave off 1.8 percentage points off the unemployment rate. Well, they're giving kind of an optimistic forecast. But you know, the unemployment rate could get up to 11, 12, 30, you get to depression levels, so 1.8% off the unemployment rate isn't enough. Similarly, in Canada, now again, I'm not as knowledgeable about the situation, but I understand you have a $40 billion stimulus plan, which was just launched, and people are criticizing Harper for arguing that that was enough, and that since they created this plan, Canada has already lost more jobs than this will create. I suspect that it's not enough, and that the problem is that people haven't been worried enough about this crisis to take big enough measures. The problem is that any stimulus plan takes effect with a lag over time, and you have to get it going. And the problem is that we have damaged when we let this happen, and we come in late with the stimulus package, it damages our psyche. I think it can damage it for a lifetime. That's the problem. We want to stop it before people lose their jobs and before they start telling angry stories about the injustice that happened to them. And that we've kind of met. I have a little anecdote about, just to remind you how long stories can persist. Back in 1933, at the bottom of the Depression, people were suffering a lot of privations. Unemployment rate was 25%. And one thing that people were doing without, this is a little story, was mayonnaise. You can't imagine, can you imagine not being able to afford mayonnaise? Well, in the 1933 Chicago World's Fair, Miracle Whip was introduced. I just checked whether you have that in Canada too. Of course you have that in Canada too. That was the cheap imitation mayonnaise that they produced for the Great Depression. Now we still have a jar of that in our refrigerator. I don't know why we buy it. I also didn't know why they don't call it mayonnaise. Well, it's because there was a company called Hellmann's, which had been producing mayonnaise since 1900. And they got the Food and Drug Administration to make it illegal for Miracle Whip to call it mayonnaise, because it wasn't the real thing. So if you look at Hellmann's, it says real mayonnaise on it. That's all part of it. But anyway, what's striking to me is that we're still buying that Depression stuff. And I don't even know why. I found out why, finally. It's a family tradition. So some families are Miracle Whip families, and some people are Hellmann's families. But there's a new example that's coming up right now. I don't know if you saw this in the news. Starbucks coffee, which I know you have here in London. They're all around here too. Starbucks coffee has announced that it's launching a new line of instant coffee. Now, you probably you probably decided that you'd never drink instant coffee again, right? But you know, Starbucks is pretty expensive, right? What does it cost around here? For a grande, it costs like $3, is that right? More than that. They can add up, right? This is the time to introduce a line of instant coffee. And so here's my prediction. 70 years from now, your grandchildren will have a jar of Starbucks instant coffee. And you won't know what they're buying. So, the other thing is we have to have normal lending. We need a credit target. And the U.S. Federal Reserve has done quite a number of innovative things. Ben Bernanke has been The chairman of the U.S. Fed is a Depression scholar. His best work is he wrote a book called Essays on the Great Depression. And so he is really, he doesn't want to say it, but I can read his mind. He's worried. And so he has been trying a lot of unusual things. So he created in 2000, it was a long time ago, how many months ago? My mind is a blur. But the term auction facility has been around for quite a while. More recently, the term asset-backed securities lending facility. And Bernanke has done this in collaboration with other central bank leaders because Bernanke knows it's an international problem. Actually, I don't know who was, I imagine Bernanke was a leader in this. So the Bank of Canada has been brought along with this, and they have their own term loan facility. It's done in cooperation. It's an international cooperation. There's also, the U.S. has cut interest rates to zero, just like in Japan. And Canada has done something similar, the Bank of Canada. The problem is that it's still not enough. And I guess it's better in Canada because your banking system is more secure. But in the U.S., credit is really hard to get. And businesses are going under left and right because they can't get credit. Just a few days ago, President Obama announced the public-private investment program. Well, actually, it was Treasury Secretary Geithner, which is a really dramatic plan for the U.S. government to subsidize lending in a different form. I think these are things that have to go forward, and I wish they had gone faster, and I think they still have to go forward more. Unfortunately, they're reaching some kind of political limit because people are concerned about the public debt and the taxpayer consequences. It's unfortunate because this concern is slowing it down. It should be done immediately before the damage is done to our confidence. And finally, I wanted to say that this is also a time to remember justice for the forgotten people, the struggling people. And this is a theme. I actually had an op-ed piece in the Globe and Mail as part of Project Syndicate about a week ago. But I thought that when people at the G20 meetings in London, the best thing for them to do, on top of having a coordinated program of stimulus, is to show some tangible concern for lower income people who are struggling the most and hit the hardest. They're not deciding between Starbucks Grande and Starbucks instant coffee. It's much worse than that for many people. Just talking about the U.S. and Canada, I think actually the most important thing is that the G20 countries should be concerned about the developing world. But let's talk about our own countries. The problem in the U.S. is that so many people are being thrown out of their houses. Millions are being foreclosed because they can't make their mortgage payments. And it's not their fault. You know, if you lose your job, you can't make your mortgage payments. And even if you don't lose the job, a lot of people are on reduced income and in difficult circumstances. It's interesting that this problem is not uniquely American because the subprime lending occurred in Canada too. It just didn't, it took the crisis came mercifully sooner in your subprime cycle. If it wanted to continue, it might have developed into something really bad. But I just read in the Globe and Mail that there's an estimate of 25,000 Canadian subprime borrowers may lose their homes because they can't renew their mortgages. And that's not a big number, but I think it's something that we have to, well, I won't tell you what to do, but I'm thinking that it's something that ought to be kept as foremost in our minds, just because of the effect it has on confidence, on our sense of justice, which I think is related to confidence. So my last slide is just a picture of the Sacramento tent city. This is from the New York Times yesterday. That's what, this picture must have been taken yesterday, so it's fresh. Why are all those tents up? Those are people who've lost their houses and have built a tent city just outside of Sacramento, California. So Governor Schwarzenegger reacted to this picture saying he's going to move that out. That won't be there in a couple days. They're going to do something about the humiliation of having, there's another word for it, it's called a Hooverville. During the Depression there were such cities when Herbert Hoover was president. But that's a reminder to me. I'll stop with that. Should I leave that up? I'll leave that up. That's a little bit of a depressing scene. But I am worried about this crisis, and I think that we can do something about it. Maybe something like what Japan did. Japan, I showed their awful experience, but it wasn't that awful. It was 1% economic growth for 20 years. Disappointing, but not that. That wasn't happening in Japan. So I think we have to be willing to do something like what Japan did to keep both Canada and the U.S. Moving forward during this crisis. So I will stop there, and I invite questions.
We have time for some questions. Somebody would like to right here.
You need to comment about the savings imbalance in the U.S., which is one of the major causes of
Right.
this.
Yeah, well, the U.S. has had a negative or zero, or nearly zero saving rate for over a decade now. In 1980, the saving rate in the United States was 10%. So it's gone down to zero in less than 30 years. My understanding is that a similar thing has happened in Canada, right? Now, I'm asking you about Canadian data, but I think that the saving rate has gotten low in Canada. It doesn't surprise me. If it happened in the U.S., it could easily happen in Canada, too. And so this is not a worldwide phenomenon. Notably, there are other countries that have very high savings rate. The prime example is China. And so the personal saving rate has been over 20% in China. And if you add up their total saving, including corporate and government saving, it's been up to as high as 50%. It's huge in China. And so the imbalance you're talking about is that China has been sending money to the U.S., I suppose Canada too, right? Financing our prosperity because they want to invest somewhere. They don't want to spend money in China. They want to invest it. So they send it abroad. And this is the imbalance. People question how long this can continue. Why should the Chinese do this? They're low income, much lower income. Why are they saving all this money and sending it over here? So that's something that I wanted to understand in our book. And the question is, how long can it go on? So we thought a lot about China. I had a Chinese student who went back to China and did some interviews and taped them, talked to people in China. We tried to get a sense about why would it be such a high saving rate in China. And I can tell you a Chinese story then, which, has anyone here recently lived in China? Tell me if I'm right. Some of you may know. Basically, the story of the Chinese economy is on everybody's mind in China. And you probably more or less know what the story is. China is a great civilization that has had hard times. And, go back 1,000 years, they invented all kinds of things. Like writing, for example, or books, or printed books. But they haven't been fulfilled. But now they're coming up because the Chinese government is encouraging free enterprise, capitalist institutions. And it's a huge revolution now. It's a grand story for China. There's patriotic feeling in China that we should contribute to this story. The Chinese government, going back to the early days of Chairman Mao, has been inculcating the virtue of parsimony. Those big red banners that you see in Beijing sometimes say, "Save for the future." So there's a sense of purpose that people have in their lives. There's much less sense of conspicuous consumption in China than in the United States. I don't know about Canada, I can't, but I know where I live, and people are showing off, and they're buying big houses to prove that they've made it. Now they're buying houses in China too. It's going on, but it doesn't have the same effect. I think part of it is that it's complicated. I may be going on about this. Chinese people are very open with each other about their economic circumstance. I'm told they tell people how much money they make. People will just ask you, how much money do you make? and you would just answer. So you wouldn't want to, you don't try to, in the U.S., that's a deep secret. No one would ever ask me how much money I make. So I can be a phony. I can put on conspicuous consumption and prove that I'm a rich person. But the whole culture is different in China. You don't want to, at least among the older generation. And so that's driven them to save a lot. It seems to me, I could go on about this, but it seems to me that these imbalances are deeply culturally ingrained, but they will probably change over generations. And that the younger generations in China don't quite have the same sense of purpose. And as the years go by, their savings rate will probably drop as well. But I don't think of it as an immediate cause of this crisis. It hasn't changed much yet.
Thanks so much. I really enjoyed that talk. I also think there's intensity happening in Seattle right now. It's got a lot of...
I thought you were going to say in Canada. But
just in my own backyard, but that's a family issue. I was just wondering, because you're a member of the economics department, sort of thinking about how your peers might be thinking about your ideas right now. And it's also been something we've mentioned a lot, and that's cultural background, ultimately. And I'm wondering if you have any remarks about, I think sometimes when other fields are criticizing economists, one thing they're thinking is that economists don't think about cultural background enough, and ultimately get to this sort of rational choice being kind of stuff. And I think in behavioral law and economics is a discipline, sometimes culture is brought up as well too. And I'm just wondering if you see your interest in cultural background and thinking about that with a sort of animal spirit idea, is that that's what's missing from sort of the realm of economics and sort of the algorithm things right now.
yeah, well, first of all, I've been in the economics profession all my professional life. And I'm just as much to blame for errors that were made as others. Maybe not quite as much. I'm not one of the best ones. And a lot of good things comes out of these departments. And particularly macroeconomics, it seems to have a problem. And I think it's partly, this is a problem with the university, that they, academic life, they tend to get too compartmentalized. And so I think that we should try to bring people together more. But I used to play, I'd ask one of the members of my department at Yale, where's the psych department? Can you point to it? They have no idea. They don't even know who's there. Or what that's the problem. The problem is, maybe it's because we're so competitive. And there's all this idea, you want to be at an elite university and you want to publish in the top journals. And young people are at a quandary. How can I do that? You know, it's so competitive. And one thing you decide early on is, I'm going to specialize really narrowly because I have to be at the frontier. So I just don't have time to read widely. I think it's better if people have more of a playful spirit in their research, and they read and talk to people with different perspectives, and not worry so much about being on the frontier. I think this whole pressure to be publishing in the top journals and trying to get recruited at a top department is not really healthy.
What's your opinion on Dean-Baker's proposal where the people that are foreclosed on, they would be able to pay market rate for rentals rather than being thrown out of the home?
Oh yeah, this is it's rent to own.
Yeah.
This is one of the ideas that's talked about. That, well, you just said it. Some people have these arrangements already that you might pay rent on a house, and if you decide you want to buy it, that rent will be accounted for as contributions to purchase of the house. So this is, there's other proposals that are similar. One of them is a proposal that people who are foreclosed on don't lose the whole house, but they lose, say, a third of the house. You stay in the house, and if only when you come to sell it, you've got to turn over a third of the value in the sale to the government. That's a variation on the same theme. So I think think there's a number of variations. I have another book, by the way, called Subprime Solution. And I had a broad proposal that, that we should think about workouts of mortgages as something that we plan for. And something like rent to own could be part, or any of a number of adjustments that, that become useful at this crisis could have been planned for and put in place at the beginning. And so I'm advocating taking some long-term thinking. Exactly which program and how it's going to work out is not, maybe we have to think about moral hazard issues and but I think that the rent to own is an interesting proposal. That, I was just at the Wall Street Journal Summit on the financial crisis earlier this week, and that was brought up. Might even be, if you read the Wall Street Journal on Monday, there will be a report of this summit, and I think you might even see it there. But I don't see rent to own as one of Geithner's proposals. Not yet.
Yes. Every time deflation is mentioned, there's kind of a panic and fear. And when you think about it, it really shows our psychology of, our need to for a little inflation, for balance. But wouldn't a little acceptance of deflation and a certain adjustment of our psychology bring about a balance that would be healthy?
So he's asking whether a little acceptance of deflation might be a good thing. I guess the reason why deflation is worried about so much is that it magnifies debts. So anyone who is in debt, in real terms, becomes more in debt with the deflation. And in the Great Depression in 1930s, Irving Fisher, who's a professor at Yale, had a lot of clout in arguing that this was a serious part of the Depression. It got everyone in a worse shape. The way to get out of a depression, it's often thought, is to have a inflation. That has the effect of wiping out the real values of debts. Maybe it's all unfair either way. Whenever prices change one way or the other, it's unfair to somebody. But also, deflation was characterized the period of the Japanese. The 2 decades of lost decades in Japan were periods of deflation. And the problem with deflation is that it makes it hard for central banks to control, because interest rates hit zero, and then they've lost that tool of monetary policy. But I think we are likely to see deflation for a while. I'm worried that we'll eventually see inflation again because of the rapid expansion of the money stock that we're seeing.
Just 2 more questions.
Do you feel that it's good policy to be bailing out these big corporations that are struggling, or should we be trying, the government's be trying to give money to companies that are doing things differently?
Well, I don't think it's good policy that we want to plan to bail out. And if you listen to what President Obama has been saying, is that that's exactly what we want to do. Or probably other people are saying the same thing. We want to devise a better economic system. Maybe this is a G20 agenda. A lot of people are talking about regulatory reform in all these different countries. So we want to make for a plan that would prevent bailouts from being needed. And that means that we have to do a number of regulatory changes. One of them that's talked about by Geithner, I think, is to have higher capital requirements, particularly for systemically important firms. He wants to have a systemic risk managing agency, which looks at all range of firms, not just traditional banks, and worries about capital adequacy. So I think we might be seeing that there will be a demand for more capital in normal times, so that there's more of a cushion against the bad times. Other things are happening. Lots of things are being talked about that would prevent the need for bailout. Why do we bail out Lehman Brothers? We didn't bail out. Why would we have been? Why do we bail out Bear Stearns? It's because they have so many interlocking contracts that if we feel if we let one firm fail, it'll have a house of cards effect. So another thing that President Obama, or maybe it was Geithner, they're probably both saying, Geithner in his talk a few days ago said that we want to encourage the development of clearinghouses for swaps and other financial contracts. And another thing that I think he mentioned is that we want to try to develop more marketized assets rather than over-the-counter. The Wall Street has been particularly happy with over-the-counter contracts because they make more money off of them. And exchanges are kind of for the people. They have relatively low fees. If we want to push more things onto the exchanges, that means more standardization, more data availability. These are the kind of things that are being talked about. And I think they'll be talked about at the G20 meeting to try to prevent the need for bailouts. But then when we do come to a situation like this, I think we have to do the bailouts because we can't let the economic system collapse around us. The damages are too... It's a little bit like you're sailing in a ship that was supposed to have a strong hull, but it had just sprung a leak, and now the ship is sinking. You don't think about hull construction now. You just plug it any way you can. And that is unfortunately the situation we're in right now.
One more question? Oh, let's take a question on this side. Yeah.
You talked about taking action immediately to avoid negative pressure on the psyche of the patient, be it the economy or people in the room. So many things are either shifting out from our feet, currency devaluations, or just generally low returns in what we would expect could have provided some return. Where can the patient or where can we look for some sort of investment, safe haven or some hope going forward?
You're talking about governments or individuals?
Either, like where would the light be in the situation we have in front of us?
See, the problem with governments is kind of a political problem, that they don't necessarily have the mandate to take the kind of stimulus package that I talk about. And they know they're elected officials, and they know that they have a clientele that supports them that may not be sympathetic. And so they're limited. Now, as an individual, this is a really interesting question. I thought you were suggesting is how to invest your money right now. There are people writing books about it. I don't trust any of those books, by the way. And so, do you want my take on that? Or? Let me give that, since I've already... That may not be your...
Going to, I'll take it, but I was asking if there's everything that seems so fundamental keeps shifting and becomes so insoluble. And where do we look?
Well, okay, so you're absolutely right. We had, in this boom period, placed our faith and our trust in things that weren't so safe. And that means we don't know what to do or where to go. There's a possibility of redistributions in the future. There's a possibility that things will be taken apart. For example, people forget that the U.S. government has defaulted on its national debt before. When did they do that? It was in 1933, at the bottom of the Depression. They didn't totally default. They just took something like a third of it. And the way they did that was they didn't say they defaulted. They'll say they'll never say they defaulted. What they did is they invalidated the gold clause. The national debt in the United States in 1933 was promised in gold. You could demand so many ounces of gold. And President Roosevelt said, it's just not possible in the Depression. We're not going to pay it. So he devalued the dollar and said, you have to take this paper money, which is worth substantially less. That kind of thing may happen again in any number of countries. And so people wonder, well, where am I? And I mentioned this inflation that could build up. There could be, it wouldn't be a big surprise if there's a massive inflation. So that could wipe out the value of some of your assets. So the question is, what do you do? And I'm going to give a very uninspired answer. I'm not trying to sell you financial products. I think this is a time for diversification across a number of assets, broad asset classes. So that means not just one thing, not just stocks, not just one kind. I would put my money in many different places, and including places that don't look so great now, including even real estate, because that's another asset class which is very different from the stock market. You know, the real losers are the people who put all their money in Bernie Madoff. You know this? Believe it or not, some very smart people apparently did that. And I just think that you have to spread your nest egg all over now. And different countries, different kinds of asset classes.
We'll wrap up the questions and I'll call on Dean Holloway to be our speaker.
Well, thank you. Professor Schiller, on behalf of all of us here today, I'd like to offer my thanks to you for what was a fascinating and an enlightening talk. I frankly can't imagine a better way to have begun the Beatty Family Series in business law. So thank you very much. And on behalf of everyone in the law school, I hope that you'll accept these as completely insufficient tokens of our gratitude to you. All right.